A financial collapse is not a single event. It's a process, and that process has already begun. Hi, my name is Francis Hunt, also known as the Market Sniper. In this short video, I'm going to be telling you why I feel it's the best time to be investing aggressively in gold. I'm also going to tell you where I think the current financial system is and why that process has already begun, and we're far deeper into that process than most people realize. And part of my third point, I'm going to give you a visual representation. We're very visual people, generally humanity, and many men particularly, but also the ladies, love to see a diagram of something. How's it working? I'm going to go through my diagrams of where you are at to illustrate the dollar, treasuries, debt, what that also means for the banking system, and why, again, I feel your only true safe haven in times like this is precious metals and specifically gold. Let's get into some of the detail and weed. I'm going to take you here right through a Substack I did recently, and we're going to outline a couple of key points about the dollar and debt. Many people get confused, but money is borrowed into existence. Recently, relative to other fiat currencies, the dollar has been relatively firm. That's not universally so. In fact, the last 3 years, you've had the likes of the peso, thanks to friendshoring and Chinese duties. Now seeing a lot of China's manufacturing for America being relocated in America. So, for example, the peso has been stronger than the dollar over the last 3 years. Generally, the Swiss franc has been. But broadly speaking, across most majors, the dollar has been pretty firm. And that typically for an American, and this is for my American friends who are big followers of us on our YouTube channel, is normally good news because imported goods tend to get cheaper. But here's how that's happening. Money is borrowed into existence. In this fishbowl that I am demonstrating, the dollar is currently strong. The dollar is currently firm and above the waterline of the fishbowl level of debt. However, treasuries, the debt markets, are underperforming all the other first world nations like Europe, Japan, and Britain. Why? Because the US pursued a high rates increase above that of the other nation states. As a result, they're paying a higher yield and more money has flowed into dollars. However, when rates go up, the debt markets go down. Here's another key aspect I'm going to be illustrating to you, and this was Tavi Costa, will be appearing on our channel later in this week, illustrating what China's been doing. Remember, they are the workshop of the world, and they are manufacturing goods that the rest of the world, including America, are generally buying. And what are they doing with that money they're receiving? Well, here's a little bit of an idea for you from Tavi's tweet or post on X. That's what they're doing on the US Treasuries. They are letting go of the standard investment for the globe, the US Treasury market, a 10-year T-bill, a 30-year T-bill. These things are being divested from. That means people are selling out of that instrument. And I'll come to why in a minute. What are they buying in lieu of treasuries? The white line. That is the line that is gold. This is showing a chronic accumulation of gold at the expense of treasuries, a disaccumulation in treasuries. That is a very, very important and dangerous trend by the single largest manufacturer of all things that the world, not just America, is consuming. And they are grabbing ever greater positions in other markets such as car making and product champions in all categories that they didn't have before. So further on, as we move in, what has this meant? So the dollar's been strong, great. But what has this meant for the US Treasury markets? This is the standard long-term Treasury. This is from 81. You might remember that as the gold high. Move up into the 2020 period, March 2020, you all know what happened in and around that particular period, and a subsequent 45% collapse in treasuries. That means nations that held the US Treasury debt has lost nearly half in the 4 years since the great pandemic that everybody is pretty familiar with. So with the devaluation of debt, the currency has gone up, but we'll be pointing out soon how both categories of assets have in fact been deflating immensely over the last century. Let's have a look at the rates up. So when people look at dollar dominance, they often only tend to have a look at the one half of the fishbowl and not see the cost of events around that. I can point out to you that the second biggest pension fund, the California Teachers Association, couldn't sell their debt. They didn't have sufficient yield to meet pensions, so they had to sell debt. The market was deemed unfavorable for selling that debt. Unfavorable. I'll leave you to determine what that actually means. That they borrowed against their debt to make the pension payments. So now they were adding further debt against their asset of debt that they couldn't sell in suitable conditions to get the money they needed. They're now borrowing against this questionable collateral in lieu of not wanting to sell while it's in a low point. So many people view the half fishbowl and they go, awesome, dollar up, without mentioning that pensions and so many other things rely on the asset of US Treasuries to be maintaining value, and the heavier guy is deeply underwater, as illustrated in the Substack. Now, some of you will go, oh, well, at least we're not Japan. Well, Japan has done the exact opposite. They've let the pressure of their currency be the release valve, and the yen has devalued. So the fat guy is on the left-hand side, with the yen being the whipping boys of the first world nation currencies. However, their debt has been retained. You can choose which part of the seesaw you are manipulating, because both are engaged in manipulation. So the Japanese treasuries should be allowed to devalue more, and the US market's dollar should relatively probably be devaluing a little quicker. But they've both chosen, of the two taps available, different ones for releasing the pressure of an ongoing parabolic increase in debt and terrible finances, both Japan and America. So whilst there's bragging rights for the USD JPY to be saying, look how much better we are than Japan, it is a bit of a fake victory in lieu of when you consider the devaluation in the debt assets of America versus the Japanese, although both should be going down as well. So what's this all got to do with gold? Well, I'm going to warn that eventually, much like we had as a microcosm with the British during the pension crisis, the seesaw can eventually windmill, where both parts get a turn at being drowned and ducked. It's kind of like waterboarding for asset classes, if you will. And that's exactly what happened when the British couldn't, because they hadn't increased rates as much as the US. And there was a pension fund that needed to make payments on their pensioners. They hadn't got enough yield, so they needed to sell their assets, and they faced the same situation that the Californian Teachers Pension Association faced. And they didn't want to crash the market, and the central bank wouldn't be very happy if you crashed the market for the debt assets, so they couldn't sell at the price that most of it, absence of real liquidity and bid. Why? Because everybody was selling pounds and going to the higher yielding dollar. They ended up with a currency crisis, the pound crashed, and their debt, because there was no bid, crashed as well. So that windmilling can in fact lead to both ends eventually crashing below. And you'll also notice I put the fishbowl water a whole bunch higher. We are reaching that point where the water level is getting so high, it's going to be very difficult to survive in either instance. And that mini microcosm that did occur, which was a temporary snap for the British during their pension crisis, was only saved by massive Bank of England intervention and the Prime Minister and the Chancellor, which is essentially the financial head, much like you would have the Treasury, Janet Yellen, being sacked, and a reversal of a very accommodative budget that was going to lead to greater debt occurring. So these are diagrams that illustrate. Now, eventually, what could happen is less and less appetite for the dollar debt as an asset class as it continues to lose value. And we must add 100 trillion, my apologies, 1 trillion every 100 days, not 100 trillion. We're at about 35 trillion overall. But every 100 days, a new trillion being added. So the government is spending like a drunken sailor and continues to add debt. Who is buying it? Anything that is proliferated in such great volume is clearly not a great asset because it is everywhere. It is always available. And what tends to happen is that market is very rigged and supported by primary dealers. And in actual fact, you will need a surge in interest rates, which actually means a collapse in the debt market, which actually will lead to a spike in dollar strength potentially for a short period. This is not a dollar bull call. A spike in strength and a collapse in the debt market. Due to the fact that nobody would wish to be a buyer, the yield that is offered has to be substantially above the true inflation rate, which is substantially higher than the Bureau of Labor stats have you understand. So why are we explaining all this financial mechanization? Many people just need a simple explanation. With the dollar getting super strong on a spike of interest rates, we could have contagion of collapse, like an exploding star, where the dollar, being the world currency, eats those most vulnerable, like the Turkish lira and other FX emergings, and explodes out into a spike before a new financial system, a new star is born out of this big collapse. So that is potentially what happens. And in that environment, a UBI, CBDC, social credit, digital ID, tokenization, surveillance finance system is born as well. And how do you have alternatives to that new system in terms of where the globalists wish to take you? Now, before we cover that, I need to explain that it doesn't matter if the dollar's been up. You're not winning by being in the dollar. Over the last 111 years, the dollar has shed 97% of its buying power if compared to gold. Remember, at $20 in and around the 30s, now 2,500 today. In short, your dollar is collapsing in value, and over the last compounded, very by sleight of hand, high inflation, low inflation, continual negative, being put on the wrong side of a compound interest equation, has eaten away at your buying power to the extent that your $100 would have the buying power of $3 today. Your $100 of yesteryear would have the buying power of $3 today in terms of yesterday's terms. That is a huge amount of loss in value. A huge amount, an absolute vast amount. And in the same time, in the last 4 years alone, since the super spike in the 30-year, you've lost almost 50%, minus 45% in debt. So you don't want to own debt instruments and you don't want to be based in the dollar. This is turning into quite a trap. Where do you go? Well, you essentially have a major deflating system. Let's think of it as a pig's bladder, almost like a football that's been popped. It is deflating. That's what all those arrows. And there's a couple of places it goes. The emergency slides take you into financial system 2.0, which will all be digitized with all the aspects I've already highlighted, and physical items that are not yet got digital proxies associated with them. Unencumbered land, for example, no debt on it, which is productive and agricultural, a part of the things. Commodities, you've seen coffee go up, you've seen cocoa go up, you've seen copper go up, you've seen so many commodities. This is the devaluation of your fiat and paper digital universe. Its buying power is getting less and less by the day, and we're all sitting in that system like monkeys on a grease pole. This is very, very bad for your long-term wealth. You have a negative compound going against you, and as this gets smaller and smaller, there are tentacles in the new system that are going to want to seek to encumber your physical assets. So just getting into physical won't protect you forever. However, it will protect you for this transition that we are facing. And I refer you back to my open statement. We are already in a process, not a single event. Just like subprime was not just Lehman's going bust. It was the whole setup, the whole property boom illicitly done, the robot signing of contracts for borrowing, the ninja loans, the pumpermentals to try get us out of the dot-com boom that originally set fire to the property market that grew and grew and grew, flipping, and all the other aspects that allowed the great movie, The Big Short, to actually transpire. What you're actually watching is a far larger collapse that is commiserate with The Big Short, the movie, which many of you will know about, that has been building and is taking. It's like a glacier in terms of its move. Unless you stop looking and you go away for a while and come back, you don't actually notice how much it shifted. Slowly at first was Ernest Hemingway's answer. There's two ways that you go bankrupt. Slowly at first, and then all of a sudden. And the setup is the slowly at first that you're all starting to notice. Many people sit and complain about inflation, which is one of the reasons why I have this meme on. And those that are truly alert realize that the US and many other Western nations like it have already essentially been destroyed. They've been set on a trajectory that will see the plane hit the mountain regardless of who the pilot is. Because the mathematical facts have been attained and ascertained in terms of course that was set 40, 50, 60 years ago, that it's almost impossible to reverse, even if you were to get a responsible person in power, which you will not. And we're going to go through a financial event that is going to lead to a catastrophic collapse of the currency fiat debt system with the associated banking system with it. And it can be masked by war, hacks, and all other forms of narratives, but it is going to happen and needs to happen. So the question becomes, how do you protect yourself? Well, I'm going to sit here and say, friends, the key asset for protecting yourself against this eventuality is, in fact, gold. So here we have an interesting article that's on Bloomberg. Gold slumps as China's central bank halts its 18-month buying spree. The People's Republic of China stockpiling has been key to precious metals rally. Spot gold drops by more than 1% after reserves data is released. Now, I want to just put it to you. Most people purchase gold when it is seen to be going up. This is what I call the FOMO effect, the fear of missing out, or the certainty effect. You want to buy something that's already moving in the direction you want it to go in. In actual fact, this often turns into being close to relative localized highs before a small pullback and correction. Here's the gold chart, for example. The last time gold was hitting the headlines and was the main story would have been the 80s when it hit 800. Then 2011, when we hit 1900, just under 1927. And then more recently, we've got a little bit of headlines, but only just when we've been starting to make the 2,500 mark. Now, why would China stop buying? Why would a headline like Bloomberg's come out? China's suspending buying gold. Well, the concern for all the central banks is that the rest of us are noticing that the institutions of central banking and also hedge funds and some of the major informed big investment funds have been purchasing gold at a substantial rate. And we as retail will start doing so too. In fact, if China owns gold, why would they care if retail pushed the prices higher? That would just mean their existing assets are getting stronger. The reason why I feel these articles come out and they say, look, no more chasing of gold. It's all over. We're all done. That's our 18 months of buying. We just did the surge. That's it. Is because they actually don't want retail to purchase gold. They want the price to ease so that they can recommence acquiring it. When you are a big buyer and your movements are very clear and many people can see you are engaging aggressively in the market to ascertain and to secure a higher gold event, what price for your goods, what actually ends up happening is everyone else starts to chase the momentum. Because initial traders and investors are momentum pursuers. In short, they are looking to do what they think is going to pay for them in the short term, not what's going to be paying for them in the long term. And remember, it's time on the pullbacks to be the buyer. The best time for purchasing would, in actual fact, have been during these periods over here in the 2000 boom, 99 and 2000, when everybody was talking about internet stocks and how stupid and old world gold was. During the mid-70s, at the end and tail end of the Vietnam War, after all that huge expenditure and just before the French asked for their own gold rather than dollars to be paid to them. More recently, during the Shanghai Accord 2016, 2017, when China went and got themselves properly over property leveraged in the property markets of 2016, and the word started to get out of how instead of a China miracle, there'd actually been an absolute boom and binge in expenditure on property investment, their own form of 2008. 2016 was China's 2008. And more recently, in the events of, you guessed it, March 2020, right the way through to the dip sell-off low in the pullback, you could have got in at almost 1600 in 2023. So you do not want to be investing near the localized highs. And we are on the shorter time frames. This is a 6-month chart, which takes you right back to the mid-70s that I'm showing you. The best time is actually now. We've had a little period of coming off for gold. Everybody's saying China's done. Most retail are no longer buying because China's not buying and the price is a little bit off. These are your opportunities. And the key element I'm going to make here is that these pullbacks are getting shorter and smaller. So this is technical charting. You can see there was a very long cycle from the 80s high to the 2000 low. Then you got a huge and beautiful bull market. This cycle, by duration, has been a lot shorter before you got the low, and then you got your next huge bull market, not as huge, but big. And now this cycle to the low has been shorter still. The cycles down in between metals is getting lower and lower and shorter, and the move is turning ever more parabolic. 1 trillion every 100,000 days is being created in new paper, digitized debt and fiat to be sent to Israel, Ukraine, for every war that everyone's happy to fund, for asylum seekers to come into your country, America, where they will be put in hotels and various other things at your cost. All spent beyond the revenue that they are getting from you in taxation. So, with that said, I hope you appreciate that the sustainability of the existing financial system is largely over. And in actual fact, what we're seeing here in terms of gold is a beginning of a major parabola that we expect during the course of this year could still meet the 2,900 doorstep of 3,000. And in the years following, we have targets to 4,500, 6,800 and beyond as part and parcel of a collapsing fiat system. Remember the football that's collapsing and inflating the new digital system, all going into the physical realm that is unencumbered by debt. Which one do you want to be? You want the physical realm, and you want the asset that comes with no liability statement on it. In 100 years' time, that bar of gold is still a bar of gold. Okay, finally, in closing, thanks for listening to me. It's Francis, the Market Sniper, that is chatting to you on ITM channel today. And I want to say a few words about ITM for my US audience, which is over 50% of our YouTube channel. I encourage and do myself invest in physical metals. And when you're an American, it's so much easier to have a local or a national US provider. There's no gold crossing international boundaries. I understand that. So who should you seek? You want a business that's been in business for a while. 28 years of ITM, cross-generational. In other words, this is not something they're doing as a gig for now. This is committed family members being passed down. You want somebody you can talk to that's not just there for a transaction. Transactions can be done online without any emotional connection, without any thought or discussion. How about that consultative approach where you get to know your account manager? where you've already discussed what you wish to achieve. There's been an educational element because we don't all know everything, what coins to buy, what bars to buy, at what times are which allocations better to have. How should you spread your spread across bars, coins? Should you have other precious metals in there as to support your performance of your gold portfolio? All of these things occur when you deal with ITM. And whether you have 5K or you have 5 million, the point of the matter is they're happy to talk to you and everybody will be spoken to. I, for this reason, feel very comfortable to endorse ITM as a gold provider to our US audience. They're based in Phoenix. Obviously, there will be no international borders crossed with that. 100% delivery, full call with get to know them first. Why not just book a call and have a chat? How do you guys do business? What's your nature of your game? Have a feel for what they like before you even commit to any form of purchase. The links for doing so are below. And I want to thank you for watching this video and for going along this short ride with me. What did we learn today? We learned that diagrammatically, currencies and debt are both in trouble and both are underperforming and in fact are going to crash, and they're in an escalating parabola of devaluation that feels slow at first, but there will be a quickening and we are not very far in this process to the point where it becomes a quickening, meaning that the purchase of gold is one of the things that you will be forever grateful for. Then we spoke about who and why you purchase now, and those details we've just finished covering. So I hope that's been useful to you. Thank you for watching, and we look forward to giving you further updates such as this on the value of the great precious metals, the big G. Till next time, catch you later. I'm Francis Hunt. Bye for now.